Hi, it's Sandra and Marina from the Valco team, and in today's frequently asked questions video, Marina and I are going to be looking at down payment, different down payment sources and what to expect and what you need when using those to buy a home. So the first one that we're going to look at is a gifted down payment, which would be a gift of money from a family member to yourself. And if that's the type of down payment that you're looking at, what would we need, Marina?
So key things to think about in this case is we need that gift letter pretty early on in the process, and we do need a letter from that giftor about how much money they're giving you, and the lender is going to call and verify those funds with your giftor. Keep in mind in these situations, we need to pay attention to who that giftor is. So it can't just be anyone you pick off the street. It's really going to be a family member immediately related. Aunts and uncles are still a tough one to sell. So keep in mind who's giving you that money. You cannot receive a gift from a spouse, so key things to keep in mind. And we always need that gift letter, and it always has to be the accurate and full amount, and that's the amount that needs to go into your bank account on that deposit.
Now, in any instances with increased sort of electronic, I guess the way that people are banking sort of is a little bit more electronic, is there any other documentation you would need to show sort of the history on those deposits into your account? I think that comes up pretty often as well.
Yeah, so keep in mind that anytime you receive deposits, any deposit over $1,500, we have the right to ask questions for, and we may need to see where that money came from. So if your giftor is giving you money in $5,000 chunks over a 10-month period, we're going to need a different gift letter for each one of those deposits, and most likely proof of that coming from your giftor. So a copy of the check or copy of the information saying that it came from that account. Large transfers or large deposits of checks or whatever have you need to be proven. So keep in mind things like stag and does. This gets really kind of touchy because you're depositing large amounts of cash. So have stag and doe tickets, be prepared to have that conversation and explain where that money came from.
That's an interesting and a really good point, actually, that a lot of people probably wouldn't think about. Now, another source for down payment that we run into is obviously people who have saved up the money and they've got it in their account sort of on their own accord. In that instance, what does a purchaser need from their bank to show what that down payment is?
So you need a 90-day bank history from the closest possible day to the day that you're doing your application. So if you've decided to purchase a house and your closing date is August 1st, we need that 90-day history to include usually June, May, and April, or whatever kind of current date is in July as well. So keep that in mind. And we need a full 90-day history. No blacking anything out. No hidden accounts, and if you have money coming from different bank accounts, anytime that transfer comes in, we're going to need the 90-day history on that bank account as well. So keep in mind, if you have a large deposit in April, I need 90 days back from April from that deposit. So it's really, like I said, really important to know where your money's going and where it's coming from so that you can provide all of those 90-day statements up front initially rather than having to wait and come back and ask you for a different bank account, different statements.
And that's really, I think, just in accordance with anti-money laundering laws and rules that are a lot more applicable these days.
Absolutely. It is all about anti-money laundering laws and knowing your customer, so knowing where that money is coming from. And it is really important to make sure that you know where your money is and where it's coming from. If you have multiple investments, be really open with that with your advisor or your broker right from the get-go so that we can prepare you properly rather than last minute having to get a new RRSP statement or a new TFSA statement or a new bank account that you weren't planning on using but ended up using for your deposit or what have you. Keep in mind we also have to prove those deposits. Now that they're getting larger, that $5,000, $10,000, $20,000 you put down with your offer, we're going to need to see the history on that too. If you're taking from a line of credit or something like that for the short-term relief, we're going to need to see that product is paid off.
So that actually brings us to our next kind of different types of down payment. So obviously, having your money in an investment is different than having it in a savings account. So with an RSP or another type of investment, what types of documents would you need? And are those even different types of down payment within themselves?
Absolutely. So keep in mind with an RSP, you can only take out $25,000 as part of the first-time homebuyers plan. So anything above that $25,000 is going to be taxed or subject to withholding tax. So you may expect to be able to take $50,000 out and then kind of in turn realize that you're only going to get $45,000. So keep that in mind. With RSPs and TFSAs, typically when they're invested, so you've worked with an investment broker or a mutual funds agent at your bank, those statements are only provided quarterly. So we need the most recent quarterly statement, and then we'll need the funds being transferred into your bank account. And keep in mind, when you do that transfer in, if there's any other large deposits that are showing on that bank account that you transferred those funds into, we're going to need the history on that. More documentation is always better, so if you think something might need to be proven, prove it.
Now, there are, I know we have talked on different types of mortgages and different types of down payment before, but going back to sort of a flex down mortgage or a borrowed down payment, is that something that you can use as a first-time home buyer? Or is that more for like a rental or a second home? And are those possibilities still to use in today's market?
So flex down is kind of borrowed down payment. So keep in mind, as a first-time home buyer, it's not recommended, especially if you're putting down 5 to 15%. It's very difficult to kind of rationalize why you're borrowing down payment. You need to be able to carry that payment. When you get closer to 20% or you're at that 20% mark, you can use some borrowed types of down payment as long as you can carry those funds. So you can make the payments on the line of credit or whatever the case may be that you're using. Always be forthcoming with your agent or advisor right off the bat so that we can properly prepare you for what that looks like. In the process of buying a second home or a rental property and using the equity from your existing home, if you're using a line of credit, we're going to need to see that that line of credit is properly registered, that the balance owing on it is only the amount that you've said it is, and then again, you can afford those payments. So if you can't carry the line of credit payment and the mortgage amount, then you really can't carry the property.
And that would all come down to the underwriting and the qualifying of that mortgage, right?
Absolutely. And keep in mind with the new rule changes that we have, qualifying is getting harder and harder. So before going in and saying you're going to buy that house and use your line of credit, make sure that we've had that conversation and we've qualified you properly.
Perfect. Thanks, Marina.